Hi class, this video is going to focus on how we close accounts in the general ledger and is going to cover content of chapter 10, pages 197 to 210 of the Macmillan textbook. Before we go through learning intentions and explain how to close accounts in the general ledger, I want you to do some thinking. What is the purpose of the general ledger? And what do you think closing the general ledger means? Have a think, pause the video. I'm not going to go through the answers of this, but I want you to have a think about this before we go through the content. So once you've done that, let's go through the learning intentions. The learning intentions of this chapter are to do 5 things. Firstly, you need to be able to define and calculate revenue, expenses, and profit, and also explain the role of accounting assumptions and qualitative characteristics in determining profit. If you're looking at that and going, I don't know this, you're not going to see the answers to that in this video. There is a previous video called What is Profit that will go through those aspects. This video is going to focus purely on the last 3 learning intentions. Can you explain the reasons for closing revenue and expense accounts? Can you record closing entries in the general journal and general ledger? And can you record the transfer of drawings to a capital account in the general journal and general ledger? If you can do all those 3 things and practice with your textbook questions, you will leave having achieved the success criteria, and you will have been able to have prepared profit and loss summary accounts, and you can prepare journal entries to close these relevant accounts, including the capital account. What the hell does that all mean? Let's start learning how to close the general ledger. So, closing the general ledger. What the hell are we talking about? Closing the general ledger occurs at the end of a reporting period. And at the end of a reporting period, when we're going to make our reports, and in this case, the most important one is the income statement, 2 processes should be completed. Assets, liabilities, and owner's equity accounts should be balanced in preparation for the balance sheet. Assets, liabilities, and owner's equity go into the balance sheet, so we balance them. Hopefully you understand what we mean by balancing. If not, there are previous videos that explain this. What have we not talked about though? Revenue and expense accounts. Revenue and expense accounts are different, and they should be closed off to the profit and loss summary account. This is what we're going to be talking about today. So if we think about the accounting equation, assets, liabilities, owner's equity, balanced, revenue and expenses are part of profit, and these are closed to the profit, hence the profit part, and loss summary account. Why do we close these accounts? We close these ledger accounts so we can transfer all the balances from revenue and expense ledger accounts to a special account called the profit and loss summary account. Why do we do this? So that profit can be calculated. So this whole process is about calculating profit, which goes into our income statement. We need to close them as part of this process for 2 reasons. Number 1, to determine the net profit or loss. And number 2, and this is the most important one really, to turn these revenue and expense accounts back to 0 balance, ready for the new reporting period. This ensures that this period's revenue and expenses are not counted again in the subsequent period. Why is this important? Because if you think about profit, profit is revenue minus expenses for a period. If this is for a year, we might have $20,000 of revenue, $8,000 of expenses. That is for a period where we've made a profit of $12,000. The next year that we do that, we start from 0 revenue and 0 expenses and do this process again. So we need to make our revenue and expense accounts, our general ledger accounts, 0 to start that scoreboard again. The only way we can do this is the profit and loss summary account. So what is this profit and loss summary account? The profit and loss summary account is a temporary owner's equity account. Keyword being temporary. Its only purpose is to temporarily calculate profit or loss for the reporting period. It is like the scorecard for a reporting period. That's why it's temporary. Temporary means it will disappear after this reporting period, after we've done it. And it looks something like this. What the hell does this mean? I don't know. We're going to go through this. But if you look at this and we think of it as a scorecard, you might be able to start to guess whether this business made a profit or a loss. And before we go through, really quick studies tip. When you're writing this down in your questions, this is one that is very few ones that you are allowed to abbreviate to P and L summary. So I might talk about that as well. But if you look at this business, hopefully you've been able to look at this and go, I think I can actually work out if it's made a profit or not. I think that maybe this business has had revenues of 34,700 and expenses of 29,400. And if I do quick maths, I might be able to work out that I think this business has actually made a profit of 5,300. 34,700 minus 29,400. If that was something that you have thought about, you are on the way to understanding this, because that is exactly what has happened. This temporary account, the scorecard, is showing our profit. But how do we get to this? How do we do this? Let's go through an example and explain the process. And before we do this, let's just explain this so we're all on the same page. To transfer revenue and expense accounts to the profit and loss summary account, it is necessary to make the individual balances of all the revenue and expense ledger accounts zero. This means, and this is the doing part, and we'll go through an example, because examples always make it easy to understand. To make these revenue and expense accounts zero, this means we are going to debit revenue accounts and credit expense accounts. When we do this, because we are doing a debit and a credit, these entries are actually going to be recorded in the general journal first and then the general ledger. Let's go through an example that explains this. Let's go through the process, first. This is the process that we're always going to do when we are determining profit. First up, we're going to explain how to close revenue and expense accounts. We're then going to explain how to close a profit and loss summary account to a capital account. We will then explain how to transfer drawings to this capital account. And once we've done that, we will have a capital account that reflects all the transactions of that calculates profit for the period, and we've done this process. So there are a few things to do. If we understand all of them and follow this flow chart, we'll be fine. So how do we close a revenue account? Remember, thinking back to Paler, revenue that increases, and we often expect revenue to increase, is a credit. So at the end of a period, a revenue account will almost always, in fact always will, have a credit balance. Like this. Sales revenue of this imaginary company was $10,000 for the month of June. How do we know this? On the credit of our ledger, we have one transaction. Clearly, we've made a sale due to cash of $10,000. In order to close off this account and make it zero, the only way to make this account zero is to do a debit entry of $10,000. How do I do a debit? When I'm thinking of debits and credits, I need to prepare an account in an entry in the general journal. So I will do that. On June 30, so the day of my reporting period, I'm going to write a debit of sales revenue to make that account zero. If I have made that account zero, I've done a debit, accounting will say I must do a credit, And this is why this P&L summary account comes in, because it is my temporary account, that is my scorecard, and that's where I put my credit. So now it will be posted to the general ledger, and my sales revenue account, you will see, is now balanced and hence got essentially back to zero. Cross-reference being P&L summary account, because in our general journal entry, the credit of this transaction was P&L summary. So I have now worked out that this business has got a total revenue of $10,000, and I've transferred that as a credit to my scorecard. We now can close expense accounts. Let's say the same imaginary business has 3 expense accounts, 3 types of expenses over the period. These being costs of sales, advertising, and wages. If you look at these, there has been $7,000 of expenses in this period. They've all been recorded as debits because we know an expense that increases is a debit, thinking about Paylor. So how will I make these expense accounts zero? Well, the only way to do that is to credit these accounts, because then the overall impact, the increase and the decrease, will balance out. So we need to do a general journal entry where we do this credit. For example, and this is how we would do it. You notice the credits are for cost of sales, advertising, and wages, and they're the same amount of the expense for that period. We've done a credit, so we need to do a debit. Accountings will say that. And we do this debit to our temporary account called P&L summary, which is our scorecard. The posting will then look like this for all 3 expense accounts. All 3 will now have credits with a cross-reference of P&L summary. And this has meant that if you look at them, they balance out, they are all been made zero. And we now recognize we have total expenses of $7,000 for that period. If we think about this business now, we've closed our revenue and expense accounts. We've worked out that we have revenue of $10,000, expenses of $7,000, probably starting to work. You've got in your head the profit figure that it should be. But we now still have a few more processes to do to actually finish this process accurately. We now have a P&L summary account that has had, that has the revenue and expense details there. This is our scorecard. And in this example, it would look like this. The P&L summary account, an owner's equity account, has recorded revenues of $10,000, expenses of $7,000 as our scorecard. You know that the difference between this is the $3,000 of profit. But this account is temporary. We need to get rid of this, make it zero so it can disappear, because the only way it can be temporary and disappear is if we actually get it to zero or balancing. So we need to do something to this account. We need to actually determine the profit and close the profit and loss summary account. So once all the revenue and expense accounts have been made zero, we need to determine profit by analysing the profit and loss summary account, which we have done. We know our profit here is $3,000. And if we have a credit balance, this means our revenue exceed expenses. And this means we have a profit. And if we go back to our previous one, we do have a credit balance. We have more in our credit side than our debit side. If we have a debit balance, which we don't have here, then our expenses exceed revenues and we have made a loss. So we need to now close this account because it must be zero because it's temporary and we don't want to make the common mistake. How do we do this? we need to balance or make this account essentially zero. How would I make this account zero? To make this account zero, I need to make each side equal the same, and we do this and then transfer the net profit to a permanent owner's capital account. Remember, we record our profit in our balance sheet in the owner's equity capital section. It's important that the profit impacts the wealth of our business, the worth of our business, and that is where owner's equity comes in. So, to balance our profit and loss summary account, to transfer our profit from our scorecard that's temporary to a permanent account, we are going to do this in this case. We're going to debit profit and loss summary to make our temporary account equal, be balanced. And our credit here is capital because we are recognizing transfer of net profit. We know owner's equity goes up, our wealth of our business goes up if we get a profit, and owner's equity going up is a credit. If we look at our profit and loss summary account, you can see that we have a scorecard that's temporary that now balances 10,000 on both sides, and it can essentially disappear. It has done its job until next time we do our reporting. We've now closed our revenue and expense accounts. We've worked out from our scorecard profit and loss summary the profit or loss. We've now made that temporary account balance. Its job is done. We still have a few more steps to go. We've transferred the net profit to our capital account. Now, the last thing we would need to do is recognize that there might also be in this reporting period some drawings. Drawings impact our owner's worth, business worth, because drawings mean worth of our business has been reduced because something has been taken by our owner from the business. This needs to be recognized and transferred to our capital account as well. So let's say we've had $1,000 of drawings. We're going to record that as a credit in drawings, and our capital is going to go down, which is a debit. We can then update our owner's capital account, our owner's equity, with both our profit and the drawings for the period. It might look something like this, and this looks a bit complicated. Our capital account could ultimately look like this, using our business example. Capital would have an opening balance because it is a owner's equity account that gets balanced. On June 30, for example, this business was originally worth $50,000. We know that we have made $3,000 of profit, which increases our business worth, and $1,000 of drawings that decreases our business worth. Hence one a credit, one a debit. We can then balance this by adding up both sides, putting both the highest number on both sides, and then going through the balancing process to recognize that the capital of our business, the business worth, is $52,000. $50,000 at the start, plus $3,000 of profit, minus $1,000 of drawings. If we make a loss, things will look a little bit different in how we do this process, but you still think through the same logic. And if we did, it might look something like this in our profit and loss summary. Expenses were more than revenues, so we made a $20,000 loss. $80,000 minus $100,000, negative 20. You can make a loss as a business. To balance this profit and loss summary account, we're going to actually, in this case, credit this account with capital. Credit this account, and our debit would be capital, recognizing that hence our business worth has gone down. And this would look like this and would be in our general journal and would be a transfer of net loss. And guys, that is a complicated process of how to close our general ledger accounts. Well done. Hopefully by now you have got an understanding and can tick off the 3 learning intentions of this video: how to close revenue and the reasons for closing revenue and expense accounts. You know how to do the closing entries in a general journal and general ledger, including the profit and loss summary account. And you can also record the transfer of drawings in the capital account along with the recognition of the profit or loss. By doing your textbook exercises, asking questions, you will leave this chapter's worth of work with a successfully achieving the success criteria, and you can say that you can prepare profit and loss summary accounts, and you can do all these journal entries across a number of case studies. Well done for watching a long video and of quite a complicated process of how to close general ledger accounts.